All right. Thank you, Tyrell. So he said I had like 2 hours to get through this presentation. And he said that you get in trouble for door prizes if you leave early. So I guess if I'm boring you, you're going to have to stick through it. Anyway, thank you for allowing me to come here, give a point. They wanted me to talk on kind of the economics of farming. This is probably the topic that is least popular to talk about in public with. It's probably the least popular that you talk about with partners in your farming operation about. There's a lot of generation things we see where the next generation doesn't understand how the farm was running or what the farm was doing or how it even was flowing or cash flowing. And any advice to the younger generation that's here, you know, bug your parents to death and talk to them about how you're making money. How do we make this work? How do we make it sustainable that this is something that you want to take over as you want to take on that next generation in succession. So uh, it's a lot to talk about in about 30 minutes here. So I'll try to probably have to go through it. But at the end, like I said, I'll answer any questions you guys have. Hats off to your board here and this. You guys do a lot of great stuff. I've given a lot of talks at a lot of different conservation districts, just seeing what's in their your pamphlet, your newsletters, the field days they've had. Very aggressive board and district. Shannon really has done a lot to try to promote these field events that they've had. They're bringing in good farmers, good speakers for that. So definitely take advantage of that they have. But hats off to your board and you guys here in Ottawa County. Background for me, we started in 1993 with 265 acres that I was able to get from my great-grandmother. We started doing some no-till in 94, looking at some stuff, and tried some wheat. No-till, it was pretty crazy to do in 94. We didn't have the right equipment. There wasn't just a lot of people that were doing anything. In 1999, we went on to minimum till. I was getting tired of setting, in that four-wheel drive tractor, bouncing through washouts, and I figured there had to be something a little bit better to do than that. So no-till was still our big issue on planting milo. We were pretty much milo and sunflowers probably at that time. Hadn't planted a lot of corn yet. In 2005, we went full no-till. Probably went to quite a few conferences that we're pretty much winding down a conference season here for the soil health and no-till conferences. Went to those, kind of tried to understand some different approaches that we could use on our farm to try to implement the no-till part of it. In 2008, we were unfortunate to have a neighbor using a pickup sprayer and a held out wheat crop that was spraying, and he caught it on fire, and it got like 8 of us. It burnt a piece of ground that we had that was failed wheat too, that wasn't harvested, and it burned it through. And so that's what got me thinking. I'm like, this is a 8, probably 4 pH soil. It's going to blow, and it's got problems with no residue on it. What am I got to do? And that was our introduce pretty much into cover crops, was him jump starting us with that fire to come through. I do not own livestock. My nephew that works for me full time, he has the cattle. That's how we're slowly trying to integrate this. We have tried many different things with renting out to ranchers, and I just never found the right fit, because most time if you're on a per acre basis, the rancher wants to take every bit of residue he can. If you're on a gains by pound per day, they want you to probably guarantee them enough pounds that you're going to have enough forage in it. And we just didn't find the right fit that we needed in that. Today we're up to about 5,000 acres, and we manage an irrigated farm, but everything I have is all dry land, cropland. So this was a definition that we kind of looked at of what farming above our means was. And I feel like the main thing you want to focus on is often unsustainable and can lead to financial difficulties, right? I think there's living above your means, there's farming above your means. There's a lot of this that is can pertain to this, that, you know, you're basically spending more than you earn, and normally will create a financial difficulty for being sustainable. It's a great thing. This is a lot of questions we ask. Do you want this or do you need it? And my wife is always good about asking me those questions, and I always say yes. So, but we try to look at a lot of evaluations of, you know, will this thing, do I want this, you know, and I've probably seen where, you know, neighbors want to keep up with status quo, and it's not a great thing, right? It can probably lead to farming above your means. An example we have in here is if you watch YouTube videos a lot, there's Cole the Corn Star that's out in Iowa that posts, he's probably one that will like kind of dive into what his financials of his farm's doing and post it on the internet. And so he had a record yield, 60 or 50 some bushels above his best farm harvest ever, was 211 bushel average. This year he was 267, has a record loss, right? So that is what I think, you know, $200 loss per acre. They were farming way above their means to look at that. My nephews this year, this will be their second year of taking on some ground and farming themselves. The one chance they thought we had a milo crop coming, and then we get popped with a hailstorm than one of the rain events that they had. And they harvested 26 bushel milo, sold it, I don't know what they sold it at the elevator, but then they also got a insurance check from RMA, multi-peril crop insurance, and they broke even. They harvested 76% below their best ever average and broke even, where these guys were 23% above their historic average in the Corn Belt and had record losses. So, right, again, great examples of what's farming above your means. The why, you know, the why is easy. It's you want sustainability for the next generation, legacy. I mean, it's always easy why we want to make more money and we want to be out here. The how, I think, is not so easy because every farm is different, and most don't know where to start because as farmers, we're pretty prideful people, and we don't like to ask for help. Most of the time, our idea is, I'll work harder to get out of debt. And a lot of times that starts a big spiral of, it keeps you in that bad hamster wheel that you can't get off. You just keep spinning around and around trying to get out of debt. So our toolbox, and every one of you guys, you know, and ladies have a toolbox. This is a great thing. This is what we look at on our farm for financials all the time. What we look at: debt load, cash flow, a bird's eye view of the farm, our risk management, crop insurance, and crop insurance options. How we look at our debt load as we review this, we look at machinery, land, and crop inputs. And when we look at that, the ROI on a piece of machinery, one thing I forgot to say at the beginning, I am a first generation farmer, so I probably have a little different aspect of than what it is. To me, we've sold the very first tractor I bought, the first combine I bought. I could care less about any of that. If it's not making me money, it's going to fly off the farm, right? I've met guys that have 5 loader tractors for 200 head of cattle, and I'm like, why do you have 5 loader tractors? Well, if one breaks down, I'm like, great, but what are the other 3 doing? You know, and so look at what you can try to make the best amount of money with on it. The toughest thing is probably to give up land that is absolutely not profitable year after year after year. If you're paying too high a cash rent on it, or it's just really cruddy ground, and you've invested time to regenerate it and it just does not make money, sometimes that is a piece of land that you want to get rid of. And I find out those are normally what family own. And it's a lot better dynamics if you can get rid of something sometimes that a absentee aunt or uncle that lives in the city owns, but all they see is they just want a high cash rent and try to make it work. Crop inputs, I can say we look at that with building with that a budget in mind. We always have different goals, and we can get through some of those, how we look at building that. Cash flow, this is probably one as a younger generation coming up, you guys really need to understand and know is your cash flow, because the banks these days are 100% cash flow lenders. You can have equity, but if your equity is not flowing, it doesn't matter. You're going to cut your line of credits. They won't loan you money for repairs. They won't loan you money for land or machinery you want to buy. So other ways we look at our cash flow too is we break it down crop by crop, or by the crops, field to field, or we look at a whole growing season. And we look at these three different ways of how we look at this. Like I said a little bit ago, we look at all the banks. I'm going to tell you, it is a good thing to have a good relationship with your banker. And I've been very fortunate. I haven't had to switch banks since I've started. I've asked them a lot of crazy questions. They probably thought we were crazy at times on what we were doing. But I would go in and I would ask them what my debt to asset ratio is. And if I have a good debt to asset ratio, I'm going to ask for 0.5% off on my loan. Worst they're going to do is say no. But you never know until you ask. But if they say you're a good customer, you're whatever, ask for 0.5%. They might give you a quarter. You never know until you ask. That's what we'll do. We look at that. We refinance a lot. It seems like people are caught up on that $300 or $400 administration fee that you have to do when you refinance stuff. But if it saves you 20 grand on the back end of a 30-year note, it's very easy money to go just spend that to refinance it. So if you can find lower interest rates, but they are dropping now. If you borrowed anything in the last 2 years, I'd look at trying to refinance to see if you can find something else to go lower. Right now, the high interest rates, if any of us have operating notes, we know what that did in 2022, 23, and 24. Probably 22 wasn't hurting us real bad, but 23 and 24, definitely when they crept up to that 8 to 10% range, that really cut into a lot of our bottom line. And I said again, they're cash flow lenders. Just remember that that cash flow is king. The bird's eye view part of the toolbox, we use this when we're looking at our cash flow. We do a lot of scenarios. What happens if the price drops 25%? What happens if it increases 25%? If it increases, can I pay off this or pay down this a little bit quicker? Or do I need the thing I've been putting off to upgrade? Can we upgrade? Typically in Western Kansas, this is normally what happens to us. We get a 25% yield drop and we get a 25% hit in market price, right? So kind of typically what we get used to. But if you figure out what your cash flow and your scenario is under that scenario, and you build off of that, their budget for what you're going to spend on your crops, you're probably going to be fairly safe. But we look at playing out all those types of scenarios. This is one of the spreadsheets that we built. There's a lot going on here. Your inputs are over here on this side, and then that number carries over here. So this, it would be our final numbers, what we spent in 2024 on probably 2,000, not quite 2,000 acres of milo, and we averaged out 205 an acre on that. So what we see in here is the sheet that you guys see where it says RMA APH. That is my actual average for my farm, actual production history. So that number, if you don't know it, go get it from your crop insurance guy all the time to find out what they are on every your field or a whole farm average. They can get you that number, because when you're doing soil sampling, I think the biggest thing you guys can get in trouble with is that number is 73, but I have a yield goal of 140. So my fertilized rec will be for 140, when I got a 10-year average says I'm not going to make that. So I'm over fertilizing, overshooting for something that is there that I think puts you at a huge amount of risk that you're failed before you even started, and once you shot that goal. Our goals are right there. When we fertilize and we get recs and we send them off or get them back, we are fertilizing for that. So the number to the right of it in red is if you're sure at the 70% level. On this spreadsheet, I could do 75, I could do 80, whatever level you are insuring at. We do the 70 because that is the highest subsidized by you guys, the taxpayers that pays that premium down, is at the 70% level. Each 5% you go up above that, it just costs you a little more out of your own pocketbook to get that. And when you look at that number, here is the 51. We had a harvest price of 467 in 2024. That told me when I had those numbers, my break even is 44 bushels per acre. So as long as I'm achieving 44 bushels per acre, we are breaking even. What I want to look at is guys will get to a point in here where that break even number, when you look in here, because that break even number is the $205 an acre and breaks it down in there. If that is above 51, you're at risk. And that's risk is money out of your pocket, equity that is not covered by crop insurance. So if you see at the bottom, it says amount of risk down here, it's 0 because that 44 is below. If I had a complete catastrophe, I'm going to get paid for 51 bushels per acre. All my inputs are covered by crop insurance. So that's where we live at. We look at this. When we were all said and done this year, I had a marketing average of 428 on the Milo, which gave us $115 bill. Again, Milo is king for us. Milo seems like it's always the crop that pays you every year in and year out for us out west. Wheat, where Tyrell mentioned wheat. You know, I have 86 acres of wheat out this year. It's the first time in 8 years I've had wheat. So we typically don't plant it because when I'd run these scenarios and look at it, my inputs are 234 an acre. I'm guaranteed 24 and a half, and I need 32 bushel to break even. So I harvested 34 average. 23% of my money for those inputs was not covered by insurance. And so if we would have had a complete loss on that, we would have been out 23% of our own equity that wasn't covered by crop insurance. So that's what we look at it. Went and sold. That's why we don't like wheat. I don't care if it's a great place to plant your corn or Milo into the next thing, and a lot of guys will do that. It is a money drainer. Most of the time when you look at the cash flow of it, it just does not cash flow, and it's too much money at risk in here for us to keep wanting to look at it. So crop insurance was the other thing that was in that toolbox. This is probably the most important thing that we look at and talk about on our farm is you got to completely understand it. The second one is have an agent that knows crop insurance. That is so key because there's so many people that sell crop insurance. Most of you, if you don't know crop insurance, it's not like you can go and get it cheaper somewhere else. It's the exact same price no matter where you go in the state of Kansas for what you're doing. So it doesn't change. You're not getting a better deal somewhere else. Where you're getting a better deal is an agent that knows the options, the policies, they know you and how you farm and understand and get you into the right stuff. I am not great on ones that sell auto, home, life. I am 100% against getting insurance from your bank that you do all your banking with, because they will want to use that to leverage you more than you want to be leveraged. So I would go to an independent agent and look at that. But they will tell you too, if you're with you got the wrong stuff, they will come out and tell you right away how many thousands of dollars it's costing you every time when you're off. So crop insurance guys are key. The options that are in there, optional units, I don't know however many you have optional units, which means each field stands on its own. So if you get a hailstorm and it wipes out that field, you're going to get paid on that field. Enterprise units, it's a value of all the acres you have planted in that county. And so if this quarter gets held out, but this one doesn't, but you have enough production to cover it, you're not going to get paid. So you're kind of running your own self-insurance on that. Enterprise units can be up to at least 50% cheaper than the optional units, which is why we find them very attractive to do what we want to do. This year we have some SEO policies. That's supplemental crop insurance, so you can buy extra policies on top of it. You got to have the worst mentality going into it because you want that county to have a loss, either revenue-wise, production wise or that for some of these policies to kick. This SCO, if you talk, it's a better policy when the price was higher than it is probably when we're down at the lower prices, like for corn and everything we're at. ECO is another one. This one was not funded, subsidized by the government very heavy, and now it is just the same as the others. If I had any suggestion to go look, have your insurance people look at what ECO will cost and could pay out this year, potentially for 2025. So that could be an option. I'm afraid the Corn Belt guys, where they're farming above their means, I think they're going to have to take out 85% coverage levels with SCO and ECOs to even cover their operating, because they're so far upside down in that. And I think bankers might make them do that if they want to loan them money. So then we started looking at some of this bird's eye view stuff is what we look at. Instead of looking at what did one crop do, what did like a 3-year rotation look like? And for us in 2014, 15, and then we had the fallow period, which is a typical practice for us out west, is wheat, milo, and then fallow. We were losing $3 in that 3-year time frame per acre. We dropped out the fallow and just went with a cover crop, shortened up that fallow period. It started making us 27. Then we decided what would it be if we had a continuous root growing all the time on there. And so that's what we looked at. So we did milo, planted a cover crop, and then would go back into milo, and that would rotate us into this. So this is how we got to where wheat was the problem child again in our rotation, where it wasn't making us money. These are just the spray operations that we looked at. In that wheat, milo, chem fallow 3-year time period, we're running the sprayer 9 to 10 times over those acres. That was about $60, and at that time when I put the slide together years ago, that was $6 is what K-State said it was costing per acre to run, have a sprayer, custom sprayer. By the time we finally get down to this milo cover rotation, we were just running that sprayer 3 to 4 times an acre over that same amount of ground. And so to look at the cost savings, it's 36 an acre just in savings on application alone that we're doing. And then you get to mindset of thinking, what is that doing for less compaction? If that sprayer is only on there 2 to 3 times a year instead of 9 to 10, it's got to be less compaction that we have on that land too. So when I talked about the wheat, this is what I hear all the time. I have to have it to plant my corn, milo into. I feel it's a cash flow issue. All of our debt normally was set up around July, August, because what do we have to sell? We sold wheat, we paid down the line of credit, the bank, then you rolled back. The bank really doesn't care if you're losing $50 an acre. They just want to make sure you're paying back cash flow. So look at that, and they liked it because it makes it happy. My first year where we had no wheat, and my upper lane line was tapped out in May, they were like freaked out like July, like, when are you going to pay this down? I'm like, when's it due? Well, it's due in December. I'm like, you'll get paid. You'll get paid. You're okay. Don't worry. But they want to see peaks and valleys. They want to see movement. Talk with your banker, understand them, let them know what you're trying to do. If you're going to do an all fall crop rotation type thing, it just makes that transition easier on it. So the paradigm shift that we started doing when we went into low input farming was, I'm going to tell you the keys to do it. And the very first one is get that debt load down. And if you don't get that debt load down, you will struggle. And I am a prime example of how we struggled with that. We didn't restructure. We didn't understand this. I needed $1 million to pay down that debt when I was doing this. And so when I went and I cut our fertility by a quarter, we cut, chemicals down by a quarter, that 750 gross income thousand was the most profitable per acre I ever raised. But my problem was I still needed $1 million to pay down my debt, which told me my debt load was way too high for what I was trying to achieve. So that's what I'll tell you, what we learned. It caught me for about 2 years in a row where I couldn't pay down my line of credit. So you started out $100,000 short one year, and the next year you're $200,000 short, and the bank will just say, don't worry, we'll just roll it. Well, how we kind of get forced into low input farming is on a $500,000 line of credit. Now I only got $300,000 to operate the whole year, not $500,000. So now you're cut. The banks aren't helping you in this scenario. They're actually cutting your legs out underneath of you because you have less to operate with. I was fortunate enough to go in and begged them to let me term out that line of credit that I couldn't pay off over 5 years, so I could have my whole line of credit to operate again. Today, I don't know if they'll do that because you might not have the cash flow to pay back that loan and your line of credit on there. But at the time, they were able to let us do that. Like I said, farmers of us were probably pretty bad. We got kind of an ego problem, that we just have a hard time getting rid of stuff. I met a guy, he worked part-time, farmed part-time. This was in 23 when feed prices were very, very high. And he's like, I'm not paying $150 a ton for feed. I'm just not doing it. And I'm like, okay, so if you're not going to buy feed, you don't have feed, I would sell your cattle. And he's like, well, I didn't work 30 years to just go sell them. He said, I got 30 years built up into this herd of the genetics. I want all this. And so my question to him was, where do you sell your calves and your cows at? Do you direct market? Do you have a special place where you're doing this? He's like, no, I just sell at the sale barn. I'm like, you have nothing special? I would sell your herd. Get out of it. But it hurt. It made him mad because he's very proudful for how he called his herd to that point. And I'm like, but the indicators are record high cattle prices, no feed for you to feed, and you don't want to buy it. The triggers are to sell, and get out. Looked at this a lot. So in 19, I don't remember how many you were farming in 19. It was not fun. Kansas had 36 bankruptcy filings in 19. And any of these states that you see that have an asterisk on here, that was a decade high filings. So this is what this chart, this is what 2023 looks like. There was 10 filings in Kansas. But what I really want to look at was this chart over here. So here's, for you guys way in the back, you can't see it, but this is 19. So that's that record high year. You guys all remember what got us through 19 into 20? COVID. PP money. Bailouts, right? Bailouts came. They came. Every one of us probably in here should have took $20,000 that was not going to get repaid, on that. And if you had 4 enterprises, you took 4, 80 grand on that. I call them the Trump bucks. We had the MFPs, the ERPs, we just started having bailout money, right? But interesting to see, and I don't like getting into politics very much, but, these are the 4 years in here. And I have seen this trend to where I make really good money farming when there's a Democrat in office, it seems like. And when there's a Republican in office, I don't do so hot farming, And so being, from Kansas where you're probably more Republican, but look at the shift drop we had right here, drop in that. And again, what did we have that they're trying to kill right now and anything? We had tons of funding for watershed projects, the climate smart stuff. There's just such a huge amount of funding that helped you in here that takes that number down. So 2024, where do you think that number's going already? They already have it released. It's high, right? It's like 70% higher filings already for 2024. So this scares me a lot, right? So is this where you butt down for the next 4 years? You don't buy machinery, you get through this and try to do what you have? I don't know. So how we kind of started looking at our finances on the farm right now is we looked at like this. So in 2021, I had equipment loans, and this would be equipment or land tied together. At this point, I didn't have any land loan in here, but we just had $55,000 of equipment. My line of credit was $500,000, so I had to pay back $555,000 to get back to zero. That's what I had to do. I had 2,400 acres of corn and milo to market that year. 2021, I didn't have very good bushels. We had a hell of a price, but $6 price in here. I needed 92,500 bushels to pay that back. That was 38 bushel average on our farm. My APH was 68. I was feeling very good about this, that if I had a complete disaster, we were going to make it through this, right? 2024, kind of where we look at it, we ended up buying some land. So my land and equipment come up higher. Here's my line of credit still. My total debt needed to be $607,000. We had 3,680 and 24 of corn, triticale, milo. I mean, Tyrell talked about however many other crops we have. This was a hard number for me to figure because I had to take all of these crops and try to figure out what an average cash price would be. And this is what we come up with. I need 134,000 bushels to pay back that debt, 36 bushel even, 51 was the APH. So again, I felt very comfortable being in this spot that if the drought kicks our butt like it has the last 3 years in a row, all my equity is covered by crop insurance that I have invested in this crop. So what it led us to be is kind of trying to be a little different. And I don't know if you've seen, there's a gal out of North Dakota that wrote the book, Farming Without the Bank. I don't know if you've ever seen it, but there's a book out there that's Being Your Own Banker. It's David Nielsen's the guy that wrote that book. It's using whole life insurance to borrow back against that policy of your whole term life insurance policy. And it's how the Rockefellers made millions of dollars. And so this is kind of their theory of how they did this. So I looked at it, read her book, went, talked to this. If I put that policy on my wife, I need her to die tomorrow. And she wasn't too happy about that. But if I put it on my parents, that's what I needed to do. My parents are in their 70s. I needed that policy on them. It was going to cost me 30% of my equity of that policy to buy that policy on my parents. And I'm a real tight butt, so I was like, there is no way I'm spending an extra $30 when our family has enough life insurance that we think we need. So we decided we were going to do this in different forms. And so how we did this is we set up a money market and we use this as our line of credit. And you must repay this back. I should put in here, I always call this is the wife's money. If I don't pay it back, she's worse than the banker to go talk to, right? You know, so we put as much as we could in there. We got up there, and so we try to run a $500,000 in money markets. And now we're using, since money markets are starting to crash, interest rate wise a little bit, we use a lot of 3, 6, and 9 month CDs. And if you know you have a payment coming in 6 months, you know, you might run a 6 month CD 2 months ahead of that, or 3 months. You start timing that. And you look at how those are playing to try to gain a little bit of money on that to make that payment of how you're doing that. So that's how we've done this. So since 21, we have been being our own bankers for this line of credit that we're trying to operate on. And it's done really well. Note right now, if you want to know a great savings account out there, Discover Card online. It's paying 3.65% for a savings account that you can put money in, 2 days later, pull it back out, right? I mean, it's a true savings account that's paying over 3%, where my one at my bank right now, I think is paying like 0.00. I don't know how many zeros there are, but it's pretty horrible. So, and that's why I say that's where we're at today. Our money market, we're using that as our line of credit. In 2024, we averaged about 3% on that money market, which was $8,200 in interest that was paid to me. I have that with my same bank just because I can pull out my phone and I'm allowed 6 withdrawals a month. Most of us know in the agriculture world, you've got about 2 times a month you really need money. You know, it used to be everyone at the end of the month. Now all these crazy companies want it on the 10th or the 15th, right? You know, so do that. And so when we look at the crop insurance of being this in our banker, so we went to enterprise units on everything, and I told you it saves us like 50%. That saves me $27,000 a year in premiums to self-insure. And I'm hoping that I haven't had the big enough loss yet to where 1 quarter over here that got hailed out, I can't self-insure enough of that loss somewhere else with what we're doing. I will tell you, if your debt load is very high, enterprise units aren't probably the thing to be looking at, right? That optional unit will probably be the better thing to look at. But if your debt load's coming down, enterprise units are pretty look at that. But with our interest, and I mean, we had savings accounts, these CDs, we have all this. We were at about $52,000 savings of being our own banker. And that would have been, what do I have written down in here? Interest at 10% on that $500,000 note was going to be about $25,000 of that. So even though $9,000 doesn't look great, it's better than spending $26,000 with the bank. You will still have a good relationship with your banker if you're doing CDs and money markets with them, because you're not like just taking it out of their hands. Because they do make more money, trust me, on lines of credits and loans than they'll make on the CDs. But if you still are making those CD deposits and you have that with them, they're still pretty happy to have that in their bank. On summary, just watch cash flows, everybody. Reduce your debt load where you can. Review that risk with these tools that we showed you here on it, and always explore your crop insurance options. Your younger generation, keep, like I said, hound your parents. Start talking to them, because I know in school, FFA doesn't do it. Nobody really wants to talk about, can I afford coming out of college to come back to this farm? And the more that your parents are upfront with you, the easier decision it's going to be for you to come back to it, not have a shock and awe of, oh, you decide you're not going to be there. I don't know what dad ever did on the finances. Now I'm lost. And I get phone calls probably once a month from the next generation taking over that they've never talked that with their parents and knew what they're doing. So if I had anything to say, just push that. This is why we no-till. Gotta have a little humor to finish it out, right? Contact info if you need anything from me, my cell phone. Only social media platform I'm on is LinkedIn. And it might take me forever to hook up with you on LinkedIn, but I might eventually get there to you on it. But this is my seed business, like I said. That'd be a whole another hour conversation about how we vertically integrate our seed and our farm together. And I do sit on the board of the Kansas Soil Health Alliance. If any of you don't know what that is, come find me afterwards. I'll explain what the Soil Health Alliance is for Kansas then. Thank you.